You're listening to the Quint's podcast.
Zomato on 14 July made a special delivery of its first initial public offering or IPO and attracted 1.05 times the issue size on the very first day. You heard that right. A company that began as a restaurant discovery platform before turning into a full scale food delivery company with presence in over 500 cities made history by becoming the first Indian unicorn to launch a domestic IPO. When the issue opened on 14 July morning, retail investors jumped at the 10% quota reserved for them and were hungry for more given that there were 2.7 times as many bids as shares available. However, keeping the celebrations of the IPO aside, brokerages and analysts have cautioned that given the company's sky high valuation, which is reported to be 25 times the enterprise value, and the fact that the company has been reporting losses for the past 3 years, the path to profitability for Zomato is not clear. Given the risk attached, should you dig into your wallet and invest right now when it is low, or hold on to see if this is only a listing boom? To answer your questions on Zomato's IPO, for this episode we spoke to Himang Jani, the head of equity research at Motilal Oswal Financial Services. You're tuned in to The Big Story, the podcast where we dissect the headline making news for you, and I'm your host, Himmat. Let's dive right into some key facts and figures about Zomato. According to a Bloomberg Quint report, the maiden offer by the company is a fresh issue of Rs 9,000 crore and a sale of shares worth Rs 375 crore by existing investors. The price band of the stock is fixed at Rs 72 to 76 apiece, giving it a hefty market value of $8 billion. Founded in 2008 by Dipender Goyal and Pankaj Chadda, the company has evolved over 13 years to become one of the front runners in India's food delivery and restaurant aggregator sector. Now, Zomato is going public as a professionally run company and not through the usual route of being a promoter-led company, since none of its 74 shareholders hold more than a 25% stake. Zomato's maiden offering reportedly attracted bids for 756 million shares, worth Rs 5,700 crore, as against to 719.2 million on offer in the IPO, which closes on 16 July. Shares that are to be allocated for the qualified institutional buyers, QIBs, were subscribed to 98%, while those of non-institutional investors were subscribed to 13%, and that of the retail individual investor was subscribed to 2.69 times. All of these figures do seem very tempting, and you may be reaching into your pocket, but hold on. What do investors have to say about this issue? We spoke with Himang Jani, who is the head of equity research at Motilal Oswal Financial Services, and his advice to retail investors is to invest only for short-term listing gains, given the excitement around the issue.
See, our advice to retail investors is that this is a good issue for short-term listing gains, so one can subscribe. The main reason why we feel positive about Zomato is that there is a lot of excitement and appetite for technology startups and new next-gen businesses. We have seen that recently, the deals which have happened at a very high valuations. And secondly, we are in the bull market, and in a bull market, IPO performances have been very good. If you see last 1 year, the average return on the listed IPOs is about 58%. And if you see last 5 technology-based IPOs which have got listed, the return is as high as 196%. So that is the kind of era that we are in, where people are looking out for good quality technology companies. Point is that companies, let's say, offering shares somewhere at around 72 to 76 range. Let's presume it is at 76. So we have to then take a call, what kind of listing company can expect given the current environment that we are in. And we think that there is going to be a very good scope to get a listing gain. We don't know exactly how much it would be. It would depend upon the market conditions at the time of listing. And secondly, from a longer term perspective, suppose you apply for long term, but because of the nature of the business, which is in an evolution phase, we do not know how much time it will take for the company to turn profitable, what kind of business model finally they will have. Those things are still evolving. We don't have much clarity. So we are saying that it would not be advisable to take a 2 year, 3 year, 4 year view. It would be better to stick to a short-term listing gain perspective.
As Mr. Jani recommended, if you're investing in Zomato, invest for the short term only, and this may be due to rising concerns about Zomato's business model. According to an Indian Express report, the company's revenue fell by 23.4% year on year to rupees 1,994 crore in years ending on 31st March 2021. However, the loss narrowed from rupees 2,363 crore in FY20 to rupees 812 crore in FY21. Zomato's monthly active users have also slumped down from 41.5 million in FY20 to 32.1 million in FY21. So, what if you're not looking for the listing gains but are in for the long ride? How soon can you see a return on your investment? What are the risks attached to a long term investment in Zomato? According to Hemang Jani, it may take about 2 to 3 years for the company to show any significant numbers on profitability. However, he asserted that companies like Zomato are not focusing on immediate profits but are seeking to build their product further through which they will earn long term gains.
It may take about 2 to 3 years for the company to show any significant numbers on the profitability. And if you see most of the other companies, like for example Flipkart or Amazon, or recently there was a deal where Farm Easy took over a company which is Thyrocare. Okay, so these companies are not necessarily focusing too much on the immediate profitability, but they are trying to build the platform, they are trying to build the client traction, client journey and user experience. Once you have done that, your platform can give you returns over a period of time, and there can be various ways in which you can monetize it. So at this stage, it would be more sensible to look for a short-term opportunity, and then as we have more clarity, we can again relook at the company and have our own view on it. So when you are buying a company in IPO, and that too a technology company at a high price, there will be definitely an element of risk, because if the market corrects or something goes wrong, then there can be some negative returns also. So we are saying that people who have a slightly higher risk appetite and who are looking for good gains, it would be better that they only apply for this versus conservative clients who do not have that mindset to go through a lot of volatility in the market.
But what about other players in the market? Are there any threats from giants like Amazon who can enter the market and steal the market share? Or even new players? Zomato's biggest rival in the market at present is Swiggy, who, according to a LiveMint report, is also in the market shoring for funds for its Series J rounds. And as of April this year, it has already raked in $800 million at a $5 billion valuation. The report further states that Amazon India in 2020 has also started conducting pilot programs for food delivery in Bangalore. However, according to Mr. Hemang Jani, it will be tough for any player to come into the market given the high cash burn required in the initial years. And at present, Zomato's fight only exists with its present rivals.
Absolutely, it is possible to have multiple players over the next few years, but we have to remember that people who have a first mover advantage, they have achieved economies of scale, and there is a lot of cash burn. So you need a lot of money in the balance sheet to be able to see through that initial 2 3 years. So those companies which have already gone through that period, they are in a better position to remain in the game. So which is why we feel that these companies have a better potential versus new players who may eventually enter into the system.
Zomato's IPO closes on 16 July, and so far it's been rather hot and tempting. However, whether it will be palatable to you in the long term is dependent upon how the company performs over time. If you liked listening to this episode, please subscribe to The Big Story for episodic updates. We're available on Apple, Google Podcasts, Spotify, JioSaavn, and most of the other popular podcast streaming platforms. For other podcasts, please log on to the Quint website, and for any feedback, please shoot an email to podcast@thequint.com.
Thanks for listening. Log on to the Quint's website and check out our other podcasts.